Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us now is Paul Jackson, Bloomberg Economy Editor, for a closer look here. It's interesting yesterday, Paul, in that we had a pretty major sell-off in the stock market, and the Bank of Japan stayed out of the market. I think this raised the notion for some that the BOJ is preparing to reduce stimulus sometime soon, and maybe as soon as next week. What are you hearing?
Hey, that reticence to buy stocks yesterday was pretty unusual. Bank of Japan has regularly bought when the TOPIX falls by more than 2% in the morning session. So it refrained from doing that. That seems to set a very clear signal out there that some policy reshaping is in the pipeline. Now, whether that happens in March or April, that is the key question. And looking at this survey of around 50 economists that Bloomberg's done, we have 54% seeing the move coming in April to raise interest rates for the first time since 2007. But we do have a growing proportion thinking that the move will come as soon as March, with 38% opting for that. Now, in terms of that stock buying yesterday that did not happen, you could also interpret that as, well, hey, Tokyo stocks have hit a new record recently. They've finally recovered the lost ground since the end of 1989. So why on earth should the Bank of Japan be buying ETFs to indirectly prop up stocks? So it's not clear-cut that this means it's March, but it certainly is a signal that change is looming.
It's possible, too, that maybe the BOJ was net sellers of ETFs. I mean, given what you're talking about in the equity market trading so near record highs, this would be a good opportunity for them to kind of sell into any weakness and raise a lot of money for the Treasury. But what struck me, too, is that we get that news, and then, less than 24 hours later, a hot reading on wholesale inflation. I'm wondering whether or not the BOJ was tapped into this PPI report, because this also would argue for a change in policy, would it not?
Hey, look, I think in terms of the optics for a March move, we have a lot of figures suggesting that, hey, a window is open and now is the chance to go. And, in central banking, it's a moving target all the time. When you have an opportunity, you want to grab it with both hands. This week we've seen GDP turn positive. So Japan managed to escape this technical recession at the end of last year. So that's looking a bit more positive, and central bankers generally want to be raising rates when the economy isn't contracting. So that's good news. And we also have Rengo wage figures coming on Friday. Now, if you look at our survey, you can see that economists are expecting a 4.1% average increase in the annual pay deals. That compares with 3.8% last year. That would be another good figure that would support a March move.
Yeah, we had that GG report saying that that was the key, that if the data significantly exceeded the 3.8% that we had last year, that could be enough, that the Bank of Japan then would move in. As Doug mentioned, we've had a sort of clutch of data that support a stronger economy.
That's right. Some of these reports, I'm not sure they're telling us a great deal that we don't already know. We know there is support among some officials for a March move. We know that Rengo data is a key factoid. Look, if that figure comes in at like 5% on Friday, I think, we're on for a March move. But if it's like, lower 4% range, then maybe it's going to still be too close to call whether they raise rates on Tuesday next week.
Even before we get the Rengo data, I mean, a lot of the wage data that we already have for Japan shows upward pressure, right? And I think I saw a story on the Bloomberg indicating that SoftBank even hiked wages by, 5.5%, something like that?
Hey, we're seeing a lot of anecdotal evidence of big companies raising wages by more than they have done in the past. And last week, the Rengo, which is the Japan's biggest union federation, said, its demands were well above last year's, its average demands from the union side. So that shows that there is greater upward pressure on the wages this year. So that all feeds into the idea that this result on Friday is going to be higher than last year.
Yeah, I think that quote from Rengo last week was that they had already seen an average wage increase of 5.85% this year, which is significantly stronger than some of those numbers we talked about. If the BOJ does want to wait, because I understand that there's more data and information that will be available before the April gathering. Well, what is that data and what will matter most?
Hey, look, the Union Federation will be tallying its initial figures from unions. And, it's the big companies that usually report first. And these are the kind of companies that have been doing well out of the economy and the weak yen and have had a lot of profits. They've got the kind of wherewithal to raise wages. The question is are smaller companies in Japan, SMEs, are they able to raise wages? Some of them are not helped by the weak yen. Some of them are hit by the weak yen because their import costs go up as a result. So it's whether they can raise wages. And so the union figures are tallied and collated and updated several times right through till July. By that time, all the small companies have reported. But Governor Ueda has said he does not need to wait until all the companies have filed. So that suggests that it's not July, it's either April or March. And by the April meeting, he will have more tallies, including smaller firms. He'll also have the Tankan Business Sentiment Report, and he will have had another branch managers meeting where his officials around the country will be able to report back and check that the wage trend in the regions is as strong as in the capital.
So right now we're looking at a stronger currency, a weaker equity market, higher JGB yields. And when you look at what's happening just in JGB yields, the banks have got to be applauding this, right? They're finally getting inflation, and that's going to basically help expand their net interest margins.
I think overall this is good for the banks, and they've been asking for the scrapping of negative interest rates ever since it started. Obviously, when you get into the details, into the weeds, it gets a little bit more complicated depending on the kind of asset breakdown of the balance sheet of each individual bank and how much they've got abroad and how much they're relying on loans as a part of their business model. You could argue that it's more the regional banks rather than the mega banks that have got gains to be made from the scrapping of negative interest rates. But I think the banking sector will benefit, and we've seen that the banking sector stocks have been outperforming the market.
Used to work for a guy that always liked to do management by walking around, and we've heard a lot of, even academics talk about that in terms of gauging the economy. So here's the question to you, Paul. You're out on the streets, I would imagine, day in and day out. Does it feel like there's a buzz? Does it feel like there's some animal spirits gathering?
Hey, you may be talking to the wrong person here because I'm not totally convinced that Japan is back, and this is like, we're back to the strength of the 1980s. I don't see that. But are there some positives, and are we at a turning point in which the economy is moving in a better direction? Yeah, right, I think we are closing in on that kind of cycle.
Thanks so much, Paul. Paul Jackson, Bloomberg Economy Editor. Joining us now in our studios in Hong Kong is Helen Qiao, Chief Greater China Economist at Bank of America Global Research. Helen, thanks very much for joining us. Ooh,
thank you for having me.
This is a very interesting time for China.
It is.
A lot of complicated questions come to mind, but maybe set the stage for us first and your overall impression of what we got from policymakers over the past week.
Thank you, Brian, for the question, and thank you for having me. I would say that the MPC probably delivered a pretty consistent message as the policy orientation to begin with. I would say that my takeaway is that there was no upside surprise and there was not so much of a downside surprise either. If you look at the growth target numbers, I would say that's largely in line, about 5% flattish from last year, and also, I think everybody is saying this number, not expecting them to cut. In the meantime, fixing the fiscal package and also the monetary policy language, we didn't see too much of a deviation between what they said and what everybody was expecting. Anything to write home about? Probably not much, given that I think people were largely expecting it will be a combination of relatively conservative fiscal deficit number in terms of the headline, and with a little bit of goodies of local government special purpose bond issuance and the ultra long-term treasury bond issuance.
Helen, I'd like to get your take on the inflation data that we had over the weekend. I mean, PPI remains in deflation. It's been that way for about a year and a half, it seems. There was an uptick in the CPI print. Now, maybe that was due to the Chinese New Year, the way the calendar fell this year. And I'm wondering whether or not you regard this as a pivot point. Is it significant, or is it just a blip and that China is going to be confronted with a deflationary pressure for some time?
That's a terrific question. In fact, I think we are scratching our heads as well, because if you look at the inflation numbers, part of it obviously came from the Lunar New Year effect, and the other part is probably the colder than usual weather in Feb in most part of China. So those probably contributed quite a lot, because if we were to have the same sequential growth from December to Jan, and we transplanted from Jan to Feb, then there is no way that this could be a positive 0.7%. It will be 1 percentage points lower. And therefore, this is saying quite a lot about the sequential changes. But how much of that is the temporary factors, as we just stated, or how much of that is coming from a growth bottoming out story? Well, I think if you look at trade data, that is suggesting that some part of this economy is doing pretty well, maybe also subject to the Lunar New Year effect. But I would say, overall speaking, there is a higher chance that when we look at IP retail sales and FAI later in a few days, we probably need to watch very closely for any sign to the upside.
If you're looking to juice the economy a little bit, it doesn't seem like it can come that easily on the investment side. You're not going to invest more in property. Infrastructure, it doesn't seem to be that productive. And manufacturing, China already has 1/3 of global manufacturing. So it seems like what we're hearing from economists is that it needs to be on the consumption side. So the question is, how do you do it? And China does not want to follow the policies that we saw in the U.S. and Europe in providing fiscal stimulus directly to households. Should they?
Well, it's a great question. It's a one question about should they, and the other question, will they? Yeah. But if we look at what they have been currently seeing, I think we probably have been seeing this for a while. So I didn't expect any disagreement, which is a dichotomous development in growth drivers. As you said, consumption is doing fine, and especially consumption of services is doing more than fine. Look at the Lunar New Year traveling data, right? The tourism revenue, the tourism numbers, tourist numbers, those were actually quite stunning and definitely a beat relative to the market mediocre expectation. But in the meantime, the investment side is still pretty sluggish. And right now, if you look at the post-Lunar New Year data, such as rebar orders or cement orders or the coal consumption used by IPPs, those numbers are not telling us that we're seeing any heat up on the investment side. So now, going back to your question, it's up to the policymakers to decide what are they going to do? Investment clearly needs more help, but are we seeing that from the infrastructure side? Not too much yet, but maybe more is coming. But consumption, are they going to subsidize consumers? We don't see that coming in the near future either.
So one of the other things we learned from the NPC, Helen, is a target for urban employment of around 12 million jobs. We're very quickly, 40 seconds or so. Where is that going to come from?
Well, where is it? Well, we think that the infrastructure investment impetus is probably going to come through the three project, advertised, which is social housing, dual use of infrastructure, as well as urban village development. But we need to see the money and need to see the actions. At the moment, we're not seeing the orders, and the money is probably flowing very slowly.
I have to tell a quick anecdote. When I took my daughter to take the SATs for college a few years back, the place was swamped by mainlanders. And it surprised me and it scared me. How are you going to employ all those people? And it seems to be coming home to roost at the moment. Helen, thanks so much for joining us. Helen Qiao, Chief Greater China Economist at Bank of America Global Research. Joining us now is David Finnerty, Bloomberg's FX and rates strategist. Take a closer look at market appetite here this morning. We've seen a little bit of strength in the yen, although it seems like it's leveled off a bit now. Dollar yen, David, 146.92. If you were a betting man in markets, which way will the BOJ go next week?
It's such a good question. I think I was heavily been in the April camp, but given all the rhetoric that's coming out, you certainly have to give a chance that March is definitely on the table. I think what's interesting, if you go back, I'm still going to go for April if you had pushed me to it. And the reason being is Governor Ueda recently said, he did say that we're not quite there yet. And obviously this data coming out Friday could be enough to swing him at the moment. But just because at the moment, he does have the most clout, shall we say. He'd said not quite there yet. And then again, there's no rush for BOJ to exit. What's the difference between waiting another 6 weeks, getting a bit more data? So I would still say at my end, April's a bit more likely, but as I said, March definitely can't be ruled off the table.
So if we can agree that the BOJ pretty much adopts an incrementalist type approach, what do they do in stages here? Do they basically stop buying ETFs? Do they change the yield curve control structure, or do they do away with a negative policy rate? I mean, is there one preference, do you think, that they might have at least initially to insert the thin end of the wedge?
Yeah, no, I think that's such a very good question. It's because the catch is, okay, you get rid of negative rates. What then? And that's really what the market's most interested in. What's next? And that's the big thing. How many rate hikes do you have this year? Do you have any more? Do you get rid of yield control? Now, the Bank of Japan has continually said, look, they hate yields jumping quickly. Every time they tweak the policy, they've been in buying policies, buying bonds. Governor Ueda had said, look, monetary easing is going to continue afterwards. So you'd think they wouldn't have to do anything radical because, again, we know the market, if you open the door, the market will sprint through it, particularly in this case, if it means like rate hikes for Bank of Japan. So I think they'll be very careful on this one. So I think they'll do it stage by stage because otherwise the market will just go, well, we're going to jump 3-4 stages ahead of you. So they could obviously scrap YCC, but again, they're going to the market, just push up rates, and that means them buying even more bonds. They already own enough bonds. So I don't think they'll want to scrap YCC at the March meeting if they do raise rates. I think they'll do it very incrementally. Having said that, the market's going to go, look, we know where you're going. We're going to go there anyway before you get there. Try and stop us. But I think the BOJ in its interest will be said slowly but surely, one step at a time.
We focus on this a lot because obviously it can really move global markets, particularly if the yen were to strengthen a lot. And to those people who are hoping for normalization, it might be a case of be careful what you wish for. And especially with equity investors, we've seen a little bit of a pullback now in the Japanese stock market of late. What are some of the consequences of a much stronger yen, if indeed we see that?
Well, I think the thing is, as you rightly said, is if you see it, because I think you have to factor the dollar side of the equation as well. And if US CPI comes out high tonight, then obviously the chance of the Fed pushing its rate cuts back obviously grows, which could see the dollar get a bid, which obviously would help dollar yen rise. But if the yen was to streak, and certainly I think the worry is that the Nikkei could definitely be sold off, due for correction, should we say, and that could be the catalyst for other stock markets to go globally. They're all in elevated territory, and it doesn't mean they can't go further, but they are based on this concept of, low interest rates, steady growth and stable growth, and which we have so far. But when they are at these levels, it doesn't take much for them to rock the boat, and normally it will come out the US side and then everyone follows the US equities. In this case, it could actually be the Japanese equities selling off that could spark equities globally to sell off in investor sentiment.
At some point, though, maybe we've already been seeing it with the repatriation of Japanese assets, selling down markets offshore and bringing that money home to Japan. I mean, is this going to be a trend, or now, given everything that we're talking about, with pretty much, I don't know that it's a known that we're going to get a shift in BOJ policy, but clearly the equity market is down from its high. Is that an indication, as though that maybe the near-term repatriation trade has hit the pause button?
I don't know if it's necessarily to do with the repatriation trade. I think there's a lot of sentiment, and when everyone's in the one trade, you're wary about, I don't want to be the last one to exit that trade, because I'm off, by that time, market's a lot lower. So when it's been so one-dimensional, I think the markets just get jittery anyway, and they're looking for any potential catalyst that could trigger a reversal of that trade, because they know if it's a mass exodus, then there's problems if you're the last one. With the repatriation trade, obviously that's something that has to be considered. But again, look, if BOJ raises rates, let's say just to zero to keep it simple, and let's signal they signal rate hikes, small rate hikes this year. If the Fed's still trying to be high, pushes back its rate hikes, and so you push yields up even a bit higher, US yields, then at the end of the day, you've still got a nice yield differential there favouring dollar yen. So the question of how much do you want to repatriate?
Yeah, let's talk a little bit about the U.S. Treasury market with the 10-year at 4.09%. It feels like this is a relatively comfortable area for the 10-year, given where growth is. The 10-year is usually not all that far off of, I suppose, where general growth is. And the U.S. economy has been pretty strong. Is this where we're going to rest for a while, between, say, 4 and 4.25% on the 10-year?
That range, I think, certainly a fair value range. I think certainly in the near term, your biggest risk for the yields going above that 4.25 range would be obviously the strong print tonight, and that fed through. If you look at the Fed dot plot next week, because that's really what market's really looking for. This is just CPI goes fed into that. All you need at the moment, you look at last dot plot, you had 8 people in the 2 rate cut or under, and you had 11 in the 3 cut or over. So all I need is 2 people from the 3 cut or over camp to switch camps, and my median dot plot goes from 3 to 2. And the market's not going to like that at all. The market wants rate cuts, not less rate cuts. So I think the big worry would be a knee-jerk reaction if that print came in strong, and if the dot plot, again, this is an if, I'm not saying it will, if the dot plot did suddenly say, hey, there's only be 2 cuts, then I think you'll see that pressure on the treasuries, and I think they would go above 4.25. If it's the 3 dot plots signal as the median, then I agree with you. I think you stay in this sort of 4.25 range.
So the dollar, then, give me your view on the dollar. Given everything that you're describing with U.S. rates, what's your outlook for the dollar?
I think, well, look, the market is biased towards rate cuts. There's no question about that. And if they get any chance to price in a rate cut, they'll happily do it. So if the US inflation data tonight comes in weak, dollar obviously gets smacked very quickly. But if the data comes in anywhere near in line with estimates, then I think you really have the question of certainly 3 dot plots next week, 3 dots, potentially of 2. And with 3, the market's still going 3 to 4, 3.5 at the moment. So I think that can be dialed back a bit more. So then I think that will help the dollar. You have to always remember, though, there are the sides. There's the ECB and the BOE and the BOJ. So you've got to factor in those into the equation. But from the Fed's perspective, I think US yields could go a bit higher.
It just feels like it should go down a little bit because, you put rates up to 5.5% when inflation was at 8%. We're a long way from that now. Doesn't it seem like a little bit of adjustment to the downside is warranted?
Well, you say at the moment, if the data comes out today, you could go, look, there's no rate cut needed at all in the near future with 0.3% month over month. That's too high to be cutting rates. So I think certainly, yes, you could cut rates later this year. The question becomes, how many rate cuts do you need to do, particularly because the effect's wearing off?
Okay, David, excellent session. Thank you very much. David Finnerty, Bloomberg FX and Rates Strategist.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.